Welcome back. Retail participation in India has seen strong growth in the recent past, with both mutual funds and IPO space getting hotter. Pavitra has now moved over to the big wall to compare the performance of both the segments. Pavitra?
So the mutual fund industry saw a big milestone this time around, right? We hit 50 lakh crores in terms of the total AUM. Now, while that's a huge positive, here's a piece from Value Research that shows you the extent of the IPO craze amongst retail investors. We saw a total of 10 IPOs in the month of November, and retail investors committed almost 5.5 lakh crore rupees to this. Now, granted, most of this money came back, but this is real money. This is money that investors were willing to put in. So let us take the most conservative calculation, right? Money which went into IPOs early in the month, so IPOs like Cello, Honasa, it would have become available once again for names like Tata Tech and others. So I'm going to look at only the 5 IPOs that came together, right? So this is between the November 23rd to 24th period. You had Tata Tech, Ireda, Gandhar Oil, Fedbank Financial and Flair Writing. The total application for just these 5 comes to 3.6 lakh crore rupees. Now hold on to that number for a second, because now I'm moving to the mutual fund side. The SIP inflow, if I take a 6-month average, is still less than 16,000 crore rupees. This is while it's at a record high, right? So the amount investors were willing to put into these 5 IPOs all together was at 3.6 lakh crores. It's almost worth 2.5 years of SIPs. That is the kind of excitement that you saw for these IPOs. Now, while the mutual fund industry is growing and growing well, this just shows you that, how much of a gap there still is. That's number one. Second, the big appeal of listing gains. And third, maybe, to end on a positive note, the potential that we could see if even a part of this money really moves to the funds.
Interesting data there. Thank you very much for joining in. Trideep Bhattacharya from Edelweiss AMC joins in to discuss the market fundamentals. Trideep, first, a word on this big rush of retail money, this increase in penetration by retail investors in the market, and it's driven up all the stocks related to the capital markets, whether it's AMC, the wealth managers, the brokerages, the platforms like BSC. Do you think this is still an attractive opportunity? Are these stocks a buy? Which one would be the top one?
So first of all, good morning. Thanks for having me on your show, and congratulations on completing 25 years.
We actually complete 24 years. We entered our 25th year, but we wanted to celebrate this year and the next year.
Okay, so hope you have many more years of adding value to investors over time. Yes, I would say that this is, what you saw in terms of the numbers is waking up of India's retail population to equities, both in the form of increasing investment in MFs and also putting money to work in the form of IPOs. IPOs is a more cyclical phenomenon. We see when markets are buoyant, the applications towards IPOs kind of increase. I think if you ask me, while everything is hunky-dory good, on the SME IPO, probably there is a word of caution in there. But barring that, the IPO market being healthy is a function of where markets are. But the inflow into MFs has got more structural tinge to it. Courtesy channels like yourself, the awareness of equities and ability for people to invest has gone up, particularly since COVID, I would say. And it has a structural change to it. And I think there's multifold expansion from here. Courtesy this, even while FIIs have been sort of negative on markets for a good while, the domestic flows, inclusive of the pension flows and whatnot, have kept the market steady. So, hang on to it. There is more to come. This is one thing that I would say.
Oh, absolutely. By the way, on this big 50 lakh crore AUM, I was looking at it just 20 years ago, it was at 1.2 lakh crores. 10 years ago, it was at 8 lakh crores. So that is the speed at which this industry has really gone up. But Trideep, talking about the market, if someone is to invest right now, there are a lot of these smaller pockets which have run up a lot, right? Names like defense, railways. Is there anything where you think that, it still looks very attractive and you would still get in at these higher levels?
I would actually point out to something that we've added recently over the last 3-6 months to our portfolios, which is exposure to the power sector. And I think overall what we notice is that courtesy lack of investments on the power side, the next 3-5 years will see power deficit come by in a good bit. And hence various elements of the power spectrum, whether it's power generation, utilities, renewables, and a combination of all of this. Over the last 3-6 months, we have added good exposure to this. I think they still have good round of earnings upgrades still behind them, and hence the stock should do well even from here. So that's one. Second area that we've added over the last 3 to 6 months is IT. We think that one of the themes that we reckon might actually come through in 2024 is bottoming out of global growth rates. And as that happens, as we see 1 year further, which is 2025, IT services might be an area to keep an eye on. Of course, this is not very immediate. Immediate quarter numbers might continue to still languish. And maybe a couple of quarters as well. But something to look out for the next 6 to 12 months, I would say, is IT. So those would be the two areas that we have added to our portfolios of late.
What about, generally the PSU basket, whether it's defense or PSUs in the railway pack, excluding power, what have you made of this relentless one-way power rally that we've seen in the PSU stocks? Would you have the courage to add on or even stay invested, or does it make sense to book profits because the valuations are now pricing in high growth, for the next 10, 15 years? And there is always a risk to that.
I would particularly, fair point. I would say, let's look at the defense opportunity. At the moment, versus where the government wants to be in the name of Atmanirbhar Bharat and whatnot, we are nowhere there. So, in fact, so much so that some of the companies that we track have got their 20-year order book full, which means that over the next at least 10, 15 years, they could see mid-double-digit growth coming through, and there will be still more work to do. So in that context, yes, the stocks have gone up. We have actually, in the context of defense, taken a particularly favorable view towards the PSUs. We think when nobody was focusing on defense, the PSU companies built their expertise. And at the moment, even inclusive of valuations, they are nicely poised to capture on this opportunity in the near term, i.e. in the next 3 or 4 years. Over time, of course, private sector companies will take over, and I think better things will follow. But immediate opportunity, I think, inclusive of valuations, I would say still looks a little decent when it comes to PSUs. On power, I would say there are segments which still are quoting at maybe somewhere in the mid-20s valuations, where if you look at from an earnings growth standpoint, we would see kind of, north of 30% growth rate coming through. So from what you pay for versus what you get in the form of growth, we think that some sections within the power are still kind of looking interesting from an investing standpoint. Of course, in general, with markets about close to 21,000, there are pockets where valuations are excessive. But there are other areas as well where we can find within the similar theme, exposure to similar theme, better growth rates and lower valuations.
But Trideep, what segments within power are you looking at? Just this big green energy push that we're seeing, or anyway, the power consumption is supposed to go up. Is it that? Is it the power financing companies? What within this pack looks exciting to you? Because everything is doing well.
So, for instance, some of the power financiers are still trading at, 1.1 to 1.3 times price to book. Now, that in my books is not particularly expensive as long as they can hold on to their asset quality meaningfully, which there has been some change over the last couple of years. Second, if you look at the need of the power today and what India is adding, so India is adding probably about 5 to 6 gigawatts per annum, whereas the need is in the range of 40s and 50s. So the 10x gap that you see between what we need versus what we are putting onto the ground goes on to show that the delta, particularly in the near term, and by near term, I mean next 3-4 years, you could see some of these companies in the form of pricing or earnings power build up quite significantly. So I think every sector goes through a period of supernormal earnings. Maybe the power sector over the next 2 to 3 years will see something similar come through. And hence, as I pointed out, some segments still have reasonable valuations. So worth investing on.
Okay, that's good to know that even if these stocks have rallied about 200, 250% in a year, maybe we've not entirely missed the bus, right? Trideep, thanks a lot for joining us. It's always good having you on the show, and we do hope to have you back on very soon. On that note, we're going to get on to a short break, but on the other side, there's lots more market action that we're tracking. We're also going to talk about the sugar stocks, which have been in the limelight. Stay tuned for all of those details.